Welcome to Stock Market Today, your market briefing with actionable insights on stocks, bonds, crypto, and the events moving markets. Let's get into it. Tomorrow's Federal Reserve policy meeting is driving positioning across every major asset class right now. The two-day FOMC meeting concludes March 18th with the policy statement dropping at 2 p.m. Eastern, followed by Chair Jerome Powell's press conference at 2:30 p.m. CME FedWatch tool shows 92% probability the Fed holds rates at 3.5 to 3.75%. But the rate decision itself isn't what matters here. It's the forward guidance, the dot plot adjustments, and what Powell signals about the path ahead. This meeting carries unusual weight. Powell's term ends May 15, 2026. Kevin Warsh is considered a top successor candidate, and he's viewed as significantly more hawkish than Powell. Markets are trying to price in that leadership transition while managing immediate policy uncertainty. That's adding a volatility premium across equities, bonds, and crypto. Let's talk Treasury yields, because this is where stress is showing up. The 10-year Treasury yield surged from roughly 4.11% on March 10th to 4.28% by March 13th. The 30-year Treasury yield is sitting at 4.9 to 4.91% right now. According to ETF trends, that places the 30-year at the 95th percentile over the past 5 years. Markets are watching whether it breaks 5%. That's a psychological level that could trigger cascading effects across mortgages, corporate debt, and equity valuations. Why are yields spiking? Multiple factors converging. Long-term inflation expectations remain elevated. Deficit spending is approaching 7% of GDP, raising fiscal sustainability concerns. According to Marymount Capital, this yield environment reflects markets demanding compensation for holding long-dated bonds amid fiscal uncertainty and persistent inflation pressures. Now here's the critical context for recession timing. Yield curve inversions have historically preceded economic downturns. The most recent negative spread between the 10-year and 2-year notes lasted from July 2022 to August 2024. Based on historical patterns, recession lead times following inversions average between 18.5 and 48 weeks. We're inside that window now. The Fed faces a complex decision matrix tomorrow. Recent economic data is mixed. Non-farm payroll data released March 6th, CPI published March 11th, showing readings near 2.4 to 2.5%, and Michigan consumer sentiment from March 14th all feed into their assessment. This is also the first FOMC meeting where the Fed must factor in economic impacts from the Iran conflict, surging oil prices, and tariff-related inflation. These supply-side shocks complicate traditional monetary policy responses because rate hikes can't solve geopolitical supply disruptions. For equity markets, positioning is shifting towards sector rotation. Growth stocks face significant pressure if the Fed removes rate cuts from 2026 projections or maintains hawkish language. Higher for longer rates compress valuations on long-duration growth names. Value stocks, traditionally more defensive during tightening cycles, are attracting institutional flows. The S&P 500 is testing technical levels that could signal rotation acceleration depending on tomorrow's statement. According to Seeking Alpha analysis, historical reactions to March FOMC meetings show distinct patterns based on forward guidance tone. Hawkish holds that removed dovish expectations trigger immediate growth stock sell-offs and yield curve steepening. Dovish holds that hint at future cuts drive risk on rallies across growth around sectors. The magnitude of the move depends less on the rate decision itself and more on how Powell frames the economic outlook. Cryptocurrency markets are bracing for volatility. According to research from CoinGecko and MEXC, Bitcoin declined following 7 of 8 Fed meetings in 2025. That's a sell the news pattern regardless of the actual policy decision. Markets tend to position optimistically ahead of meetings, then de-risk immediately after. Let's run scenario analysis for crypto. In a hawkish hold scenario estimated at roughly 75% probability, the FOMC removes rate cuts from 2026 projections while citing persistent inflation. Bitcoin could drop 8 to 12% over the following week, retesting support around $65,000. Altcoins would see amplified moves due to liquidity dynamics. In a dovish hold scenario estimated at 25% probability, the Fed adjusts dot plots to indicate two potential cuts in 2026. Bitcoin could rally 3 to 5% immediately following Powell's press conference. But even in this scenario, historical patterns suggest the rally fades within days as markets reassess actual economic conditions. FOMC research highlights that institutional positioning ahead of Fed meetings creates asymmetric risk in crypto markets. Long positioning into the event amplifies downside when profit-taking accelerates. Short-term traders should monitor Bitcoin's $65,000 support level, volatility expansion in altcoins, and correlation patterns with equity risk assets. Fixed income traders are laser-focused on specific technical levels. The 10-year note is testing resistance that could signal a breakout toward 4.5% if the Fed maintains hawkish language. Bond futures positioning shows significant short interest, indicating market participants expect yields to move higher. The spread between the 10-year and 30-year is widening, reflecting term premium expansion and fiscal concerns. iShares research on Fed Outlook 2026 emphasizes that fixed income strategies need to account for policy uncertainty during leadership transitions. Markets historically add risk premium when central bank leadership changes, particularly when the incoming chair has different policy philosophies. Warsh's hawkish reputation means even if Powell signals dovish intent tomorrow, markets may discount that guidance knowing policy could shift more hawkish by mid-year. Sector-specific implications are critical for equity traders. Financials benefit from steeper yield curves and higher net interest margins. Utilities and REITs face pressure from higher discount rates on their dividend streams. Technology, particularly high-growth names with negative or low earnings, sees multiple compression as the risk-free rate rises. Energy sector dynamics add complexity. Oil prices have surged due to Iran conflict developments. That feeds inflation pressures the Fed must address, but also supports energy equity valuations. If the Fed acknowledges supply-side inflation it cannot control through monetary policy, that could signal tolerance for above-target inflation. Energy names could outperform as inflation hedges. Trading considerations for tomorrow's announcement center on timing and positioning. The policy statement at 2 p.m. Eastern often triggers immediate algorithmic reactions, but the real market-moving information comes during Powell's 2:30 p.m. press conference when he provides context and signals future policy direction. Volatility typically peaks in the first 30 minutes after the press conference begins. For risk management, recognize that tomorrow's meeting sits at a critical inflection point. Treasury yields at multi-year highs test whether the bond market believes the Fed can achieve soft landing or whether recession risks are building. Equity markets face sector rotation pressure as growth versus value dynamics shift with rate expectations. The leadership transition from Powell to potentially Warsh adds medium-term uncertainty that extends beyond tomorrow's meeting. Markets attempting to price future policy under new leadership create additional volatility premium in options markets. That makes tactical positioning more important than strategic bets until leadership clarity emerges. Key monitoring points through tomorrow's session. Watch pre-announcement positioning in bond futures and equity index options for clues on institutional sentiment. Track the immediate reaction to the 2 p.m. policy statement. Focus on Powell's press conference, language around inflation outlook, employment assessment, and most importantly, his framing of appropriate policy for the remainder of 2026. Monitor Bitcoin's reaction as a leading indicator for broader risk sentiment shifts. The research makes clear that while the rate decision itself is nearly certain to be a hold at 3.5 to 3.75%, the broader implications of forward guidance, dot plot revisions, and Powell's commentary on the economic outlook will drive significant moves across stocks, bonds, and crypto. Markets are positioned for volatility. The question is whether that volatility breaks to the upside on dovish surprises or downside on a hawkish confirmation. Critical levels to watch: 30-year Treasury at 5%, 10-year Treasury at 4.3%, SP 500 technical support for growth versus value rotation signals, and Bitcoin at $65,000 support. These levels represent inflection points where positioning could shift dramatically based on tomorrow's Fed communication. That wraps your market intel. Trade smart out there. For deeper insights and real-time analysis, visit capitalcopilot.io.